Investor psychology contribute to these boom and bust cycles?
Well, to be honest with you, Nadine, I think it's the major driver. Now, it doesn't act in a vacuum. Investor psychology does play a huge role, but it's often triggered by something positive. So if you go back to I'll stay away from the current situation with AI, and that may be becoming a bubble. But if we go back to the tech boom of the late 1990s, there was lots of reasons to be optimistic back then. But that optimism obviously propelled markets to excessive valuations, particularly for tech stocks. And then, of course, the market got ahead of itself as a result of investors piling in, pushing share markets higher, and then had to go through a severe correction in the early part of the 2000s. And of course, once you go from extreme optimism, you can then plunge all the way down to extreme pessimism as investors are in a rush to get out. But there's a combination of investor psychology traits that drive that. But one of the big one is this tendency for investors to project recent strong gains or recent gains off into the future. So if the current environment has been very positive, lots of good news, people will assume that will continue. Then they pile into the share market, pushing it to extremes. It starts to feed on itself to some degree, and then that eventually sets up a bust.